All right. Go get him. Yeah. All right. Yeah. There we go. Aiming from Waterloo. Yeah. Mr. Cahilil.
Okay. Thanks for everyone to this conference, and thanks for the LTP. And so, at first, I'd like everyone to introduce yourself and your company. Okay, let's begin here.
Hi, my name is Takatoshi Shibayama. You could call me Taka for short. I head the APAC region for Copper. Copper is a digital asset custodian. We service mainly institutional investors. We have our headquarters in London, office in New York, Switzerland. We even actually opened an office in Hong Kong as well, so we can service Hong Kong clients very soon. So very excited to be here. Thank you, LTP, for inviting me for the second year in a row.
Hi, my name is Gerald. I'm a co-founder and CEO of Singapore for Sygnum. Sygnum is a digital asset banking group with global reach. So we've established headquarters in Switzerland and Singapore. And from those two corporate hubs, we address the European and Asian regions. We also establish ourselves in Luxembourg and the UAE with plans to roll out in other parts of Asia and Europe in the coming year. Across the group, we service more than 1,800 clients at the moment. We focus on institutional investors, corporates, high net worth individuals, as well as other regulated financial institutions. Collectively, our clients have entrusted us with more than 4.5 billion of assets that we help them to administer. Very much looking forward to the panel today.
Good afternoon, everyone. My name is Amy. I look after the sales team for Fireblocks here in APAC. Fireblocks provide secure digital asset infrastructure. So unlike many of the folks on the panel here, we're actually a technology provider, right? Meaning we work with regulated or unregulated institutions to help them to either store the digital asset, move the digital asset, and then do different, on-chain activities like contract calls, tokenization, DeFi, and so on and so forth. Our journey actually started in servicing the OTC brokers, right? Galaxy is probably one of our earliest clients at the time. And from there, we realized that clients needed to send assets to and far from each other. And then we moved to retail exchanges to now today, we're working with some of the largest financial institutions, corporates, as well as payments companies.
Hi, everyone. My name is Abel. I'm a sales director at BitGo. For those of you who don't know BitGo, we're a large global custodian, as well as a tech provider. We've been around since 2013, and we're a pure B2B business. So quite literally, any business around the world that needs to touch crypto, that needs to touch Web3, we like to think that we're in a good position to serve them. And that really spans across the board. Governments, sovereign wealth funds, regulated banks and asset managers, right across to exchanges, miners, platforms, and all the weird and wonderful in between. Thank you.
Hey, I'm Zhang Cahilil. I'm the COO for Galaxy Digital's Asia business. Been at Galaxy the last 2.5 years. Galaxy Digital is a global investment bank, merchant bank, focused solely on the crypto space. We have a markets business that kind of looks a lot like a sell-side, traditional bank business with sales and trading, wrapping a whole bunch of products for customers. We do principal investment on balance sheet. We also do borrowing and lending. As well as advisory, so classic investment banking type advisory business. We have an asset management business with just over 10 billion of AUM on the platform across a whole range of products, all the way from a single asset Bitcoin fund, which probably nobody will ever trade again, all the way through to actively managed liquid coin strategies and all points in between. And then the third pillar of our business is an infrastructure investment sleeve, which we do have a Bitcoin mining operation in West Texas, and an enterprise custody solution called GK8 that we sell to enterprises.
Okay, thank you very much. And I'm Colin from WuBlockchain, crypto media. Oh, sorry. So the next question is, what do you think the most important thing when you provide banking and custody service? And so let's John first, and Gerald and Taka. Okay.
The most important, I'm going to hand off to one of the providers of custody. I can tell you, as a user of custody, but why don't we maybe go a slightly different direction to start? You want to start?
I'll take the bit on custody. Gerald's in a much better position to talk about banking for the good work that Sygnum do in the space. But it's a really important point about custody for us because I think custody in digital assets is quite unique compared to other industries, where if we are approved in a particular jurisdiction or region, it means that the regulators trust our track record, they trust our technology, they trust our ability to comply with the local requirements in the jurisdictions that we operate in. And on top of that, it's also about the technology, right? If BitGo supports a new L1, a new blockchain, it also means that BitGo has done a fair amount of due diligence, a fair amount of work in acknowledging that it's a legitimate business, it's a legitimate blockchain, it's not going to be a rug. So these are the things that we have to think about and makes custody quite unique. And because we are a B2B business, if we turn the switch on for our clients, it means those end users then get access to that technology as well. And therefore, the considerations are at the very top, the regulatory considerations. If you want to come into a new market, are you willing to put up the capital required to fulfill local regulations? Are you able to comply then with the operational setup and the funding of the operational setup to be consistently compliant with the requirements as well? So these are the things that we think about, and therefore it takes a long time. It's a very long process that we go through to ensure that we are consistently able to compete and be local to our clients in the jurisdictions that matter to us. I'll let Gerald talk a bit more on the banking side.
Thank you, Abel. So when we think about banking for digital assets, when we think of banking for crypto, I think you can draw a line pretty much from like the pre-FTX and the post-FTX worlds, right? I think pre-FTX, I mean, Sygnum has been around since, incorporated since 2018, and we received our Swiss banking license in August 2019. So we've been providing banking services to crypto players, to Web3 players for a really long time. But prior to the collapse of FTX, late 2022, I think the level of sensitivity and appreciation of regulation and importantly counterparty risk was very low in the industry. Right? I think we constantly, I remember at that point of time, my team and I constantly being challenged about the necessity and the need to work with a custodian bank, especially when it entails in many instances a little bit more cost than if you were to go with a pure play technology provider, let's say for the same services, custody of digital assets, just to name one. Post FTX, I think no one asks those questions anymore. I think especially if you are an institutional investor or if you are a fund or asset manager handling third-party capital, I think there's a great amount of appreciation now of the need to evaluate counterparty risk, on the need to work with trusted, regulated banks and custodians. And even more so, I think there's also a double-clicking and a deeper appreciation of exactly what licenses those counterparties operate under. So for instance, for Sygnum, we benefit from the fact that the Swiss Banking Act was changed in, I think it was 2020, to quite specifically identify digital assets, including cryptocurrencies, that Swiss banks provide custodial services for as being bankruptcy remote, that is off balance sheet for the bank. Consequently, our clients, right, our clients for our custodial services, they don't take any counterparty risks against Sygnum at all. And in the very unlikely situation that something were to happen to us, they would have direct line of sight and certainty towards the ownership of their digital assets. And it's not the case that these sorts of regulations and are uniform and global in nature. I think the clients really demand this of us, and they're very much more aware of the nuances between each jurisdiction. And so I think the banking world will have to continue to play catch up. I think banks in Switzerland and other geographies where there's much more regulatory clarity will continue to also be able to offer the full range of services that the Web3 and crypto industry demands. much better than banks that are operating in jurisdictions where there's a lot more legal ambiguity.
Yeah. I'll say something that's a little bit different from everybody else. I think the banks generally, if you're an institutional investor and you're going to a bank and say, hey, I want to trade crypto, I mean, obviously they're not going to provide you that access. They are dabbling with a lot of the tokenization of real-world assets, et cetera. That's an area that they can really compete in because that's what they're known to be doing anyway. So if they come to a custodian like Copper or whoever it is, they want to be able to access different crypto services through us. Basically, if they want to bring in fiat into crypto, they will need the channel to convert that crypto into fiat. At this point, most of the digital asset custodians have been regulated one way or another to offer that banking rail. I think the next step right now is how do you get just fiat people who couldn't touch crypto to get into crypto in a different way. I think a lot of the institutional investors that do have the authority or got the authority to trade crypto has already gone into this space. And we have seen a lot of the participants that we've seen in the past bull markets come into crypto and trading a lot more during this bull market. But how do we get the next level of people come in? I've had a few clients, even in a past bull market that came to us and said, look, I want to trade crypto, but I'm not allowed to touch crypto. I just have fiat. How can I get into crypto that way? One answer is you can go to prime brokers. Some can offer that type of service where clients can onboard with them, give them the fiat, and then start trading crypto based on their balance sheet. As a custodian, we have to start to innovate in a way that we can bring that fiat money into crypto in a more creative way. One of the things that including us, are starting to think about is how do we kind of dip into more of the TradFi rails, getting a securities broker's license somewhere so that people can come in through fiat using that rail, not just with fiat, but maybe with like U.S. Treasuries or other securities, using that as collateral to bring in, converting that into crypto, and then trading in the crypto space. So I think that there's, rather than just relying on banking services to kind of get into crypto, I think the crypto industry and will continue to innovate in a way that we can become a conduit between the crypto and the TradFi space.
Yeah. Actually, some crypto institutions, they even try to acquire some banks, right? But in different countries, the situation are very different, and maybe the government may stop this action. Yeah. So my next question is, what do you think the retail and institution clients, crypto clients, to face the problem from the banking system and how to solve it? John, first, thank you.
Yeah, I mean, I think Gerald hit on it straight away. I think for institutions, I'll speak from the institutional perspective, that's really kind of the core of what we are. Counterparty risk is extremely important. Now with SBF behind bars, people and the market has kind of rallied to a point where we've seen all-time highs again. People forgot about counterparty risk again. That's all anybody wanted to talk about in the post-FTX world. The first 6 months is proof of reserves, and now we need to look at liabilities, and we need to get all this information. We need it right now, and it needs to be a prerequisite to doing business. That was true for 6 months, and now people have forgotten. Right? That risk hasn't gone away. That risk is still out there. It might have gotten pushed into different corners of the business. We do liquidity provision, and we make markets and a whole bunch of exchanges. We bear a lot of that counterparty risk, and there is not a great solution in the market that exists today. That's a really important thing that needs to get solved. I think it's actually incumbent a little bit on the market participants to speak with a voice and to put the right pressure, commercial pressure, on exchanges, on our custody partners to solve as an industry. Because I do think for real direct coin investment from real money institutions, I'm talking endowments and pension funds, like the real deep pool of real money, these things need to be solved science before they're ever going to make an investment. They might invest in a fund vehicle that bears that risk, or they might pay a very high premium for an insurance against that risk. But until those things are solved, the industry is not going to attract direct capital investment from real institutions. So I think that's a really important thing that I think we need to continue to keep top of mind as we progress on this journey. I actually think that the easiest on-ramp for anybody now is an ETF. You know, the ETF adoption is, and like there were ETFs before the U.S. had an ETF. Okay, I'm aware of that. But that BlackRock did not have their name attached to any of those things. Those things are transformative in the way people view our space, and they start to bring the world of traditional finance and our space together. Right? You can go and buy an ETF at Goldman Sachs and get leverage on it. Right? That gives you access to traditional capital markets in a way that did not exist. Right? We spend a lot of time worrying about financing our business and kind of growing capital and borrowing capital against our asset base. Crypto's a closed system, very much in the financing world, and until some of these solutions become more integrated and there's more product offering, and we solve some of these sort of industrial challenges, it's going to remain a somewhat closed system.
I actually think when you say counterparty risk, it's not rather crypto is immature and traditional industries is more mature. Actually, the difference between, say, Bitcoin versus fiat is there's no backstop, right? If something goes wrong, if you're talking about fiat, and banks do mess up. You've seen people forget, right? Like financial institutions have had various different issues with AML, various issues with mismanagement, with incorrect management of their balance sheet, and ultimately allow bankruptcy. But the difference is when a bank, hopefully they're globally significant or domestically significant, if something happened to them that is mismanaged, there is always the backstop, which is the government that would then later on decides to, in some shape or form, rescue the particular bank and ultimately allow the customer that additional level of security. When it comes to like digital asset custodian, such mechanism does not exist, which means that the hurdle actually is much higher because they're all bearer instruments, right? So I think a lot of the comparison between, a bank is much more safer, people often forget that actually bank is way more leveraged, right? You think about versus a traditional exchange or a custodian. A bank has way more financial instruments that they're managing that's built on top of the underlying deposits. So from a risk perspective, actually, like a traditional digital asset custodian has no leverage, right? Like I'm sure if you ask like Taka and you and Abel, like how much leverage do you guys offer on the back of the customer asset? It'll be zero, right? So I think that's where things are really different on counterparty risks. But I would say the one thing that is getting a lot more attention now is that conversion between asset to the exposure, which is the Bitcoin ETF, but settled in a fiat currency, which then you do get to receive the guarantees or the trust you have to the fiat system.
I think it's a really good point, actually. I'll just elaborate a bit more on what Amy just mentioned and John as well. And we were talking about it behind, right? Because that question post-FTX still is as relevant today as it was back then. And having a walled ecosystem maybe is not the way forward. Right? Because from an institutional point of view, it's no good paying 2x, 3x the fees to 4 different people. So I guess, with the partnership we have with Copper, with what we're doing with other providers as well, hopefully that opens things up a bit more, makes it easier for investors to come in. And to Gerald's point just now, right, when investors do their DDQ, when they ask the difficult operational questions, is the bankruptcy remote structure there? Is there regulatory compliance? Is there insurance? Is there a track record? All these things become more and more important, and they're not going to go away anytime soon as well.
Yeah, at Copper also, we've always been on the forefront of thinking about counterparty risk, and I'm not going to talk about Cahilil anymore, but we've been building these concepts out as much as possible. We've even put it in a trust structure. All the clients' assets are segregated. We've been working across different custodians to make sure that trading is safe. From an investor's perspective, we have insurance. All these things are put into place. But in the end, what is more important is, as what Amy said, is like we need to have some kind of like crossover between the TradFi worlds and the crypto space so that people can settle in like fiat or more familiar ways that they're used to. And then I think that right now, like crypto is like just very isolated within the crypto space, that everything has to be done in crypto. And I think that the next bull market is about kind of crossing over that. ETF is one of that, but we have to think about like other infrastructures or concepts about how to like remove those barriers between the two worlds so that capital can go in and out fluidly.
maybe just let me say something in defense of banks and traditional banks or crypto banks in the space, right? I do think that when it comes to counterparty risk, it's true. Banks, depending on the businesses and the services that they offer, can entail some leverage in their capital structure. However, banks also benefit from having very much more direct oversight by regulators. They also have to, hold up regulatory capital against those assets. I think the fact of the matter is that many of the real money investors that John talks about, the ones that we really, want to see and we envisage, coming into the space in the following years and will really help to change the complexion of crypto and greatly accelerate its acceptance as a mainstream asset class. I think those folks are very particular also about the financial institutions that they choose to build crypto exposures through. And I think there's a role, being a bank, having CET1 capital against the assets, and most importantly, the level of trust, real or perceived, that banks have, right, in the minds of these institutional real money investors. It's just a very different order of certainty and magnitude, and versus more, maybe more leanly regulated custodians and other sorts of financial institutions. So there is a benefit for the bank. I mean, it's highly and extremely costly, right? Like we have, for instance, at Sygnum, north of 100 million US just held aside as regulatory capital requirements that we can't touch and won't touch. But these requirements then that we adhere to help provide that certainty and that safety and that security, right? And reduce counterparty risk in a meaningful way. The other thing I would say though is I think a lot has been said about leverage in the banking system. I think for us, keeping a very watchful eye on the loan-to-deposit ratio, which is a more classical measure of checking how leveraged your bank is something that we are very focused on. So we have an LDR that's probably less than half that of a more traditional Swiss private bank, and we do it quite consciously because we don't want operating in the crypto space as a bank is already quite a interesting and challenging thing to do. We don't want also to cause any undue concern when people look at how we are leveraged and what we offer on the loan side. So we do make a point to keep those ratios well within the green zone, maybe even above and beyond what you would expect from a Swiss private bank.
I want to mention quickly just regulations, because I think it's something in the custody space has been somewhat light, and historically it's very light. It's not a very regulated industry in traditional finance, and so regulators move slowly. Let's call it what it is, and I think a lot of times our industry points the finger and says, oh, they just don't understand, they don't get it. I'm not really there anymore. I think I've engaged enough with MAS, with SFC, with HKMA, with SEC, certainly our company has. I don't think it's a lack of understanding. It's a lack of wanting to do something that has unintended consequences and then ultimately looking really bad in hindsight. And so they're going to be very deliberate. They're going to be slow. And they need guidance from the market. They need to hear from market participants. They need to hear from vendors and service providers on what their clients are asking for, and they want engagement, and they want a roadmap of, all right, well, what should we do? I would say, at least in this part of the world, I found at least the thinking to be progressive and the action probably not to match that. But it is a little bit incumbent on the industry to drive some of those conversations in the direction of travel on the reg side. I think we're going to have regs around custody in Hong Kong in the not too distant future. That sort of stuff is out there.
But I think the difference people compare is like the end state to while in the beginning of the financial industry have had hundreds of years of failing and succeeding and failing and rewriting legislations and putting them back in place. Like people talk about this current state of financial institution as if it just came like that, the way digital asset has. And that lessons of learned is through what made them secure, right? And I think our industry is also going through these type of learnings as well, and hopefully learn much faster, and doesn't take us 300, 400 years to come up with a proper infrastructure to govern and make sure that it is allowing and suited for our industry. So like people always compare, I always compare the crypto industry a lot of times with like the newer technology regulation, like how regulation is being developed for autonomous driving and how regulation is being developed for data and data laws, right? These are all new tech that is pushing new use cases what the regulator needs to go have clarity on. And I think the nuance actually is like learning from what has worked in the financial services industry and trying to figure out a way that could allow us not make the same mistakes that they've made. And if you look at the situation of FTX, it's precisely the mistakes that the financial old industry has already made before, right? So you could have learned from it, but we didn't, so.
Yeah, FTX, actually, I think maybe when SBF is out of the jail, right? He's a really
20 years later?
Yeah, he's a really a big fan of many bankers, I think. And so I think our time is limited. So the last question is, actually we'll know this year is very different, like the ETFs, like the Bitcoin halving, and the more strict regulation, many license for stablecoin for exchanges. So for your company, what do you think about the new situation this year and how to face it? So let's begin here.
Yeah, regardless of all the things that are happening in this space, copper still does see gaps in the market that traditional finance has that crypto doesn't. Is one of the things is prime brokerage, and we oversee that. Obviously, LTP is a well-known prime brokerage business in this space, but I think that almost a year and a half ago when Celsius and all the others collapsed, there's been a huge gap in this lending market, and nobody has really came back in size to provide that leverage. And I think that because of the lack of additional capital into the space, a lot of it's been through like ETFs and all this, that it's been circulating, and we haven't seen more of that. So what we're trying to do at Copper is trying to, because we've been always using custody as a base layer, but also we've been talking about prime services. I mean, we're not doing prime brokerage, which is a very different thing because it's very capital intensive, but as an infrastructure, we can provide the infrastructure for prime brokerage businesses to be able to do what they need to do. So, one of the things that I've been really concentrating on is how to get back that capital into this market by using, Copper's clients to make them with like loan only with the trading firms so that they can have additional capital to trade. One of the things that we've also seen with the RWAs obviously the secondary market is not something that's going to be built overnight, and it's going to take a lot of time. But what we can do is that because there's a fundamental value for that, why can't we use that as collateral to borrow as well? So we have our securities brokerage license in Abu Dhabi, which we got last year. We're going to try to use that so that we can use RWAs and even traditional securities for collateral so that they can borrow from that and then trade through Cahilil and other ways that they're looking to trade. So those two things is something that we've been very, very focused on since last year, and then we're trying to roll out this year.
Colin, as you mentioned, the ETFs have been a game changer for our space, and certainly for us, we are seeing a lot more engagement and curiosity by real money investors, by institutional investors, by family offices and the like. However, the lack of access to banking rails continues to be a problem that's endemic to the industry, and it's a global issue faced by anyone here on the market side. So we continue to work closely in partnership with industry to solve these problems, and I think we're very well positioned to engage both market participants but also the regulators to formulate or roll out more responsible regulation to enable the industry to access just very basic and very much needed banking services in a fully regulatory compliant fashion. At the same time, we know that this is not something that Sygnum can undertake by ourselves. And so working with other traditional banks to educate them about crypto use cases, educate them about how they can integrate crypto offerings into their suite of products and services is something that we also focus a lot of time and effort for. Earlier this year, we announced a partnership with Post Finance in Switzerland. It's the third largest or second largest retail bank in Switzerland, 2.4 million customers. And now all of those 2.4 million customers can log on to their e-banking applications on mobile, on web, go to the ATM of Post Finance and actually buy, sell, and hold crypto assets with Sygnum in the back, being a white-labeled service provider. So it's just another example of, I think, how we can bring mainstream banking and financial institutions into the fold. And once they start interacting with crypto, they realize that it's not as spooky or as mysterious or as worrying as they think. I think that will result in the provision of more regulated financial services to everyone in the space, which is something that's much needed.
Great. So I think I'll talk really three main trends that we're seeing and the pain points in these trends. Number one, so talk about ETFs, right? People think trading Bitcoin ETFs is very easy, but if you are a authorized participant or you're a PD in Hong Kong, looking at the workflow that's required for you to communicate with asset issuers, liquidity venues, coin OTC providers, the cash custodian, the crypto custodian, as well as the PD themselves, there's no existing rails between all of these participants, specifically when it comes to Bitcoin ETFs, right? So if you look at what happened in the US and look at the orchestration flows that the US ETFs needed, is very complicated and actually quite inefficient for the market makers because they're effectively short cash every day. So one thing we're doing is taking what everybody loves about Fireblocks, which is Fireblocks Network, taking a lot of the tooling that we already have, and because all the different pieces of the participants are already Fireblocks clients, we will do a orchestration tool that allows these participants to easily communicate with each other, agree on the subscription and redemption flows, as well as then have an audit trail of which that they can collapse the coin leg as well as the cash leg together. So that's one aspect. On the other aspect, I would say is more closer to folks maybe in this room is things around DeFi, right? I think one of the things people always forget, in every bull run, after the Bitcoin ETH rally starts to happen, then it spills over into all the DeFi activities. We're seeing tons more adoption now happen in the DeFi space. Clients are expecting the same level of security as they do in the CeFi world, now into the DeFi space. So what does that mean? They want to have contract decoding, ability to get very granular control over their smart contract activities. That's something that we already have out and people love us for. The final piece I would talk about is the non-financial use cases, right? So I think one of the things we forgot during the last years is a lot of corporates today are already launching a ton of use cases around loyalty programs. But the new hot topic at the moment is corporates launching stablecoins, not just banks, but corporates who've got large net in corporate ecosystem where they're paying a lot of money away from within company-to-company settlements, or they've got a very active and a loyal set of customers where now they want to provide additional services to them. So those three things are really areas that we're seeing tons of action happening this year.
I think for us, it's also three sort of main things that come to mind for the year ahead. The first thing would really be the core of what we do, the provision of custody, the provision of wallets, and being good at that, right? So we're obviously a provider for a couple of ETFs in the US, and hopefully we've been framed for a couple in Asia as well. And then the use case gets quite interesting after that, right? Today we're a pure B2B business, but based on the work we've done for, say, Swan Bitcoin, right, where we enable their end users to hold their Bitcoin securely through Swan with BitGo infrastructure, we think that's an area that we could develop further to have a full B2B2C model and scale that up front as well. The second part that I think is going to be really important for us is around what we're doing for our off-exchange settlement network. That's great because we can do both crypto, but we can also do fiat as a regulated custodian. So guess what? You can do crypto to crypto, fiat to fiat, fiat to crypto, crypto to fiat. And I think that makes it quite unique. And for the likes of Galaxy, traders, asset managers, if this works, why would you not want to bring your entire ecosystem into that network as well? The last thing for us that's particularly interesting is the work that we do with coin foundations, right? For a lot of these coin foundations, among the first 3 or 4 checks that they sign, one of them is typically to BitGo, because we will do the work to integrate their mainnet, go live with them upon TGE, and then help their early team members custodize, stake those assets, allow early investors the ability to custodize and stake those assets. And as the unlock comes up, if they want to monetize, liquidate those assets, the Go network, the off-exchange settlement piece, the prime services piece is there to facilitate the entire life cycle for them. So I think these are three main areas that we're really excited about. And hopefully over the course of the bull market we see this year and next year, hopefully, there'll be a lot more iterations of this from our side to announce as well.
Cool. I know we're kind of running out of time here. I'll try to be brief. I think what we're expecting and a little bit hoping for is more clarity and more change. Clarity in regulation will certainly help us make more investments, looking out a much longer time horizon. More change around things happening in DeFi that are a little bit more structured, a little bit less driven by storytelling, and a little bit more functional. We're getting more and more into DeFi as an organization than we ever have. I think that's a huge area of growth for us, but it has to be done in a way that we can deploy real money. And so that's an area we're really excited about and spending a lot of time. And then look, just scaling what we do to address all the needs of the market. We're a large solutions provider in the trading area, and ultimately that's what we think we're here to do. And getting some clarity will help us be more robust in that effort. I'll leave you with that.
Okay, thank you very much. And so let's end here. And if everyone wants to talk more, you can connect with our guests after the panel. Okay, thank you very much.
Thank you.
Thanks very much,
everyone.